Do you want to know the best time to make a credit payment in order to raise your credit score? We'll demonstrate to you in detail how and when to make payments, as well as the most effective methods for raising your credit score. Welcome to the Financial Flow. Please like and subscribe to our channel and turn on notifications to stay up on our latest videos. In contrast to your monthly bills, your credit card statement gives you the option to choose the payment amount and a variety of payment options. Your budget and your financial objectives will determine the best method for paying off your credit card. It can be a little confusing with all additional charges on top of your credit card statement or bill. What percentage of your credit card bill should you pay? A sample credit card statement is provided. The amount due for the statement period or billing cycle is listed under new balance, and we also have the minimum payment required. This indicates that during this statement period, we'll have a minimum payment required to avoid late fees. Depending on the credit card you use, this could cost you anywhere from $25 to $35 a month. You will only need to make one full monthly payment if you have a charge card, such as the Amex Gold Card. We also have the payment due date, the deadline by which you must make your minimum payment. Therefore, you won't be assessed any late fees if you make the minimum payment by this date. However, as a side note, you will be subject to interest charges for any billing cycle or statement period in which the balance is not paid in full. Let's move on to your credit card bill a little bit more. Most of the time, you can find out what your credit limit is in your statement. Additionally, you can see how many days are left in your billing cycle on your credit card statement. Most credit cards have a cycle of between 28 and 31 days. When exactly should your credit card bill be paid? The most important aspect of using credit cards is to avoid late fees and pay off your balance in full before the statement due date each and every month. You won't ever have a credit card issue if you use this method consistently on every single credit card bill you receive for the rest of your life. Having another source of passive income is the main benefit of a credit card. A return of 1 to 5% for a particular category is really not all that much, but you would still be earning extra money because you would be purchasing items you would have purchased regardless. Let's discuss the best time to pay off your credit cards to improve your credit score. You will always get a statement in the mail or via email if you have a credit card. The credit bureaus will then receive this information. The three credit bureaus are Equifax, Experian, and TransUnion. How is a credit score calculated? Imagine a pie chart with 100% filling. 35% of the pie represents your payment history. 30% represents the amounts owed, or the correct term is credit utilization. 10% represents new credit. 15% represents the length of your credit history. And 10% represents your credit mix. Therefore, your payment history and outstanding debt account for 65% of your credit score. Thus, you won't experience any issues if you make payments on time each and every month. The sums you pay on your credit card bill will be taken into account when calculating your credit utilization, which accounts for 30% of your credit score. Let's assume that you only have one credit card with a $10,000 credit card limit, and for a month, you make the decision to purchase a lot of items at a cost of $5,000. If you were to wait until your credit card bill arrives in the mail, the credit bureaus would already be aware of this information. $10,000 divided by 5,000 equals 50% credit usage. Your credit score will suffer if your credit utilization rate is high, because it indicates to lenders that you pose a greater risk. In general, 30% or less is the ideal credit utilization across all accounts. I would strongly advise make some early credit card payments in this scenario if you are anticipated to make a sizable purchase. Therefore, by the time you receive your credit card statement, your balance will have significantly decreased. And once this information is reported to the credit bureaus, it will demonstrate that even though you are using this card, your credit utilization is not high. So if you put $5,000 credit card with a $10,000 credit limit, pay off $3,000 of it right away after making those purchases. Your information will be reported to the credit bureaus, which will significantly raise your credit score, when your subsequent statement arrives in the mail and only shows a new balance of $2,000 for you. When you pay off your balances in full, this will give the impression that you are actually using the credit that is available to you. Let's now talk in greater detail about credit cards that offer introductory 0 APR rates. These are regular credit cards just like any other, but for the first 12 to 18 months, they are a little bit different. This is more frequently seen with credit cards that allow balance transfers as a part of a promotion to attract new customers to a specific credit card. When you use this credit card to carry a balance, you won't be assessed interest for at least a few months or until the promotion expires. Depending on the credit card you do have, you might only need to make the bare minimum payment each month to maintain this card's 0% APR. You might, for instance, have one of these cards with a $10,000 credit limit. You load $9,000 into this card each month and are required to pay $35. As long as you make your payment $35 payment on time, you won't be assessed any additional fees or interest. Your credit utilization will be impacted by the fact that you do have a balance on a credit card with 0% APR. You have two credit cards, let's say. One credit card has a 0% APR, while the other is a standard, traditional credit card that you may have had for a while. There is a $10,000 credit limit on each of these credit cards. $9,000 are owed on your credit card with a 0% APR, while there is balance on the other credit card, $2,000 amount. Thus, you currently have an overall balance of $11,000 and a credit limit of $20,000 available to you. In this case, even though you aren't paying interest on the card with a 0% APR, your total credit utilization is still 55%, which will have a negative impact on your credit score simply because it is too high. But just to be clear, your credit score does change as your credit utilization decreases and your credit history lengthens. Your credit score will gradually increase. Some claim that in order to demonstrate to the credit bureaus that you are using your credit, you should always carry a minimal balance on your card. Simply settle your debts in full to avoid being assessed interest. Let's now discuss auto payments, another method for paying off your credit card. Each circumstance will be entirely unique because each person has a different billing cycle. The auto payment setting on your credit card is what is the majority of people advise doing in this situation. This function is offered by every single credit card company. They typically have two choices: pay the minimum amount due each time their balance is due, or pay their entire balance when their new balance is due. The best course of action is to always have an auto payment set up for the new balance, with a due date of 4 to 5 days out. In this way, you won't ever miss a payment, saving your money on late fees, and you won't just make the minimum payment, saving you money on interest. However, as a side note, if you do choose to have your balance paid in full each and every month via atomic payments, avoid making any additional payments because doing so could result in overpaying and leaving you with a balance on your credit card that is less than zero. Therefore, unless you request a check, the credit card company will simply keep this money on hand until you spend it. In actuality, paying off your credit card bill after it is due is the only bad time to do so, because all of the potential drawbacks, not only will your credit score be impacted, but you will also incur late fees and interest. Paying more than necessary is never a wise move. However, the credit bureaus might not notice that you are using this credit if you pay your balances in full each and every month before receiving your credit card statement, which really doesn't help your credit score. The best thing to remember is to keep your credit card usage across all of them at 30% or less. Pay the entire balance when you receive the statement in the mail or via email. You achieve the best of both worlds in this matter. Thanks for watching. Don't forget to leave a like and subscribe to our channel for more content like this. Have a good one.